The housing market has finally received some great news for once in a while.
Oh, finally!
The Fed has been continuing to push interest rates up all year, which is more than double mortgage interest rates within just a year's time. So much so that the average interest rate for a 30-year fixed mortgage reached over 7% in early November. Now that some economic reports have started to come in, we're seeing that interest rate increases have started to show some signs of slowing down the inflation rate. This has been the goal of doing all these interest rate hikes all along, so it's great to see that they are actually working. As a result of the good news of inflation finally starting to slow down, 30-year fixed mortgages dropped significantly in the third week of November. Hi, my name is Trenten Ward, and if you're new here, feel free to subscribe for the latest real estate news, tips, and tricks. And give me a like if you find any of this content helpful. According to Freddie Mac, fixed rate 30-year mortgages dropped from 7.08% to 6.61% in just 1 week's time. This is actually the largest weekly drop in over 40 years.
Say what?
Say what?
That spells great news for those that are currently shopping for houses or planning to get one in the near future.
Yes!
If you have already been approved for a mortgage recently, chances are that you can get a lower rate now and save some money on your monthly payments. President Joe Biden recently expressed his praise of the new PPI report, stating, "It's more good news for our economy this morning and more indicators that we are starting to see inflation moderate." The PPI is just one of the two main reports that came out that have influenced this recent decline in mortgage rates. The two main reports are the Consumer Price Index, also known as the CPI, and the PPI, which is the Producer Price Index. The Consumer Price Index is basically a report that tells us what the average cost of typical goods and services are for the average customer. This includes things like food, clothing, transportation, and of course, housing. The other economic report is the Producer Price Index. This is a similar report, but it reflects how much it would cost companies to produce those same goods and services. So you might be asking yourself, what does this mean for the housing market? I think this can be taken as a positive sign that we are at least on the right track. In reality, this strategy of continuing to raise interest rates to slow down inflation hasn't been in play for that long, and we are already starting to see changes in the right direction. CNN reports here, even though inflation data is moving in the right direction, the Fed has said it does not expect to back off raising interest rates until inflation gets closer to the desired 2%. And we aren't exactly close to that mark yet. Now, this could be a sign that the Fed will pump the brakes on the major interest rate hikes. Staying at the current interest rate levels could continue to move us in the right direction, but I doubt that we're gonna see that.
And that frustration boiling over.
Home prices are continuing to drop all over the United States. Realtor.com recently said that more than 20% of listings have seen price cuts, and I'd expect that trend to continue until our market finds some sort of balance. Okay, if you've enjoyed the content, let me know by hitting the like button. If you'd like to stay up to date with the latest real estate news, tips, and tricks, consider subscribing. If you're in the Dallas-Fort Worth area and have any real estate needs, feel free to reach out to me. My contact information will be in the description below. Until next time, peace.